You are watching the screen. The setup was there, you clicked buy, and now the price is dropping fast. 2 hours ago, this morning session looked entirely under control. You had charted the levels, identified a clear statistical edge, and mapped out a logical, researched plan for entry and exit. Now, staring at the red numbers ticking down, the logic vanishes. Your finger hovers over the mouse, tempted to drag that stop loss down just a little further to give the trade room to breathe, or worse, close it out to flip short and immediately get the money back. When the brain evaluates performance based on a number that fluctuates every second, it loses the ability to distinguish a good decision from a lucky one. The urge to break your rules stems from looking at a feedback loop you cannot control. Judging a trading session solely by profit and loss forces the brain to focus on unpredictable external factors. You are looking for a sense of security in the market's movements rather than your own actions. That focus on the external immediately degrades execution quality. The brain interprets a dropping P&L as a visceral threat, overriding your analytical pre-market plan with a reactive urge to survive the moment. Stepping off this emotional treadmill requires a change in focus. To maintain composure, you must choose to meet a process goal before the next session begins. Psychologists categorize this stress response using a concept called the locus of control. When your focus is on the market's movements, your locus of control is external. Feeling anxiety when an external force dictates your success is a natural human instinct. In trading, this instinct is challenged by outcome variance. Outcome variance explains why the final score on your screen is an unreliable way to evaluate your actual skill in the short term. This matrix charts rule adherence against profit. Look at the highlighted quadrant here. It shows a trade where a trader breaks every rule and chases a terrible entry, but due to pure market randomness, the trade makes money. On the flip side, we have this quadrant. You can execute a flawlessly planned setup and manage your risk exactly as intended, yet still take a financial loss. If you rely on these randomized outcomes to tell you if you did a good job, you confuse your brain's reward system, essentially rewarding bad habits and punishing good ones. Over a single day, outcome variance makes your P&L a measure of probability. It does not reflect the quality of your decision-making in that isolated session. Setting a rigid goal to make $500 today means you expect the market to provide exactly $500 worth of readable opportunity. Your attention is locked onto an unpredictable chart. When the market chops sideways instead and the target is out of reach, your nervous system triggers an alarm. You are falling behind on your quota, so the brain demands immediate action to close the gap. The way to bypass this biological trap is to anchor your attention entirely on controllables by establishing a process goal. A process goal defines a specific action that is completely within your power to execute. This might mean waiting to enter a trade only when a highly specific, pre-planned setup appears on the 5-minute chart. Think back to the trader in the red lit room. Instead of dragging the stop loss down, they notice they are judging the trade purely by the P&L. Recognizing this, they pause, take their hand off the mouse, and allow their original plan to play out. Professional longevity relies on optimizing your execution quality, focusing on the steps you take rather than the unpredictable daily outcomes. Of course, the desire for profit is why you opened the platform in the first place. You cannot simply ignore the financial result of your work. You can, however, intercept emotional reactivity by altering the specific criteria you use during your post-market review. For your next session, try this. Track exactly one process metric right alongside your traditional P&L. Next to the ledger of dollar amounts, you add a single checkbox labeled with an action entirely in your control, such as honored stop loss. This changes the definition of a successful day. If your setup fails and you close the session mathematically red, but you hit your stop loss exactly as planned, you check that box. You have achieved your process goal. Scoring yourself on your own behavior has a calming psychological effect. You reclaim your agency because your success is no longer tied to whether buyers or sellers dominated the tape. Tracking both numbers allows you to isolate your own agency from market noise. You gain the ability to remain disciplined because you aligned your definition of success with actions you can actually repeat tomorrow. As you shut down your screens this afternoon, answer this. What did you control well today, regardless of P&L?